Hey everyone, this is Kirk here again at OptionAlpha.com, and thanks for checking out this weekend's video update of all the trades we had on Friday, the 25th of July. Pretty active day for us, and before I get into all of the opening, closing, and adjusting trades for yesterday, I want to talk a little bit about the group coaching session and the email I sent out about that, trying to get some feedback from everyone about this new idea that I had that was brought up on one of my coaching sessions with one of my premium members. And the idea of doing these maybe once a week or bi-weekly group coaching calls with a small group to start out with, so maybe 15 to 20 people at the top end as far as numbers, but going over going over in depth a lot of topics that maybe just aren't covered out there. And I sent out an email last night to everybody that's on our email subscriber list and our members and everybody that we have, and got a couple hundred responses from people that said they were interested in doing it. So I can't believe I didn't think of it before, and it was actually my wife's idea to do this, and this guy on our coaching call have said this before. But the whole idea here with group coaching is that we're going to break down topics that are usually hard to go over in a blog post or even a video tutorial and do it live as far as a webinar. You'll be able to call in, see my screen. We'll do all the video conferencing. Everything will be recorded for you. I still haven't narrowed down how much it's going to be for one of these coaching sessions, but I can tell you for sure that for members of our site, you're going to get a discount in some of these group coaching calls because you're already on the membership here at OptionAlpha.com. So obviously, I want to give you guys first access to that and first right of refusal before I send it out to just our big email list of subscribers. But anyways, if you guys still are interested in group coaching, please let me know in the comments below this video. Add your suggestions of topics that you'd like to see, maybe strategies that we'd like to cover more in depth, or talking about setting up the Thinkorswim platform or your daily routine, whatever the case is. Like I said, I've gotten a couple hundred responses from the email blast that I sent out, which is awesome, and I'm starting to compile all of those into topics for different group coaching sessions throughout the month. So now that that's covered, we can get into the trades for Friday. So we had a pretty active day on Friday, closed out our two great trades in BIDU and Pandora. Those were really wonderful trades for us as far as earnings trades. So I want to cover these two first before I get into any of the opening trades and then our just one adjustment in ECM. So as I mentioned in the video just the other day, with both of these trades in BIDU and Pandora, like Facebook and Microsoft and a lot of things with earnings, is that once that earnings event comes out, you see a big crush in volatility or big drop in implied volatility. Now what we're trying to do with these earnings trades is just trade them the very, very closest contract. In this case, this was the weekly contracts that actually expired on Friday yesterday. They had 0 days left. So we basically traded the most front contract available and just purely take advantage of a drop in implied volatility. Now, obviously, we know that the stock is going to move in both cases. And so we made our strangle very, very wide, both on the top and on the bottom, to capture a pretty wide window of opportunity. Okay, so in this case with BIDU, we went out and sold the 225 call and the 190 put. So that gave us a really, really wide strangle, and we were able to close this out just a couple minutes after the market opened for a 121 debit, which took in about $130 in profit. And really not too bad considering we were in the trade for probably about 30 minutes total between Thursday and Friday. But if we go to the chart here of BIDU, you can see how big the stock jumped after earnings. It was really kind of, again, leading up to this earnings event. The stock had continued to rally and had a huge jump and really did really good as far as earnings, crushed it in all the numbers. But at the end of the day, you notice that the stock actually closed at 226.76, so that was outside of our range. Now, I've talked about this before, and ScanDisk from just last week is a great example of this. A stock can open inside of our expected range where we put our strangle, but that doesn't mean that at the end of the day it closes higher or lower than that open. So I always suggest with these earnings trades that if you place a a strangle right at the market here to open for earnings, and as soon as the market opens and that stock is trading inside that range, whatever profit you have kind of right at the open in the first 5 minutes, you've got to take that profit. We could have obviously let this thing sit here and try to get the other $120 or whatever it is But at the end of the day, the stock actually moved outside of our range, and so we would have kind of lost most of that profit, okay? So I definitely suggest that when you do this, that you absolutely, emphatically close out the trade right after the open, and BIDU is a great example of that. Now, I'll show you guys how quickly implied volatility dropped, and just to recap for those of you, because I've had some comments about this, how to get this implied volatility on the chart, all you do is you go up here to Studies, and go down to Quick Study, and go all the way down here at the bottom, and you see that there's volatility studies, and you can do implied volatility right here. So quick study, volatility studies, and then implied volatility. Now here is a look at implied volatility for BIDU, and I'll just make it really big so you guys can see just how dramatic this drop was. But notice, like we had talked about before, that BIDU's implied volatility right after that earnings event happened just absolutely dropped like a rock. It's now very, very low, right? So we had an opportunity to take advantage of a big move in implied volatility and these option prices starting to decay. Now, the other trade that we did as far as earnings was Pandora. Pandora is a little bit different because it traded the other direction. So BIDU jumped higher, Pandora jumped lower. We had originally done a 31 call on the top side and a 25 put below the market. Now, at the end of, or at the morning yesterday when Pandora opened, it opened much lower. We were able to close this thing out literally, I think, within 30 seconds of the market actually opening for a 19-cent debit. So we took in about $56 on each of these strangles that we had sold. Again, very good profit for the amount of time that we were in the trade. I'll go over to Pandora so you guys can take a look at this chart. And you'll notice that the stock opened lower and actually rallied much lower than 25. So it got into 24 and started to, become troublesome area right after the open. But that's okay. At the end of the day, it actually ended up right around 25.75, but still remains that we closed it out right at the market open. So as soon as it opened, we had a good opportunity to get a profit. It's not worth running into another situation like ScanDisk for some people out there who didn't close out the trade so quickly, to run into a situation where the stock opens lower, you have an opportunity to take a profit, but you get a little bit greedy and you try to go after that last amount of money in the strangle, or that last $20 or so, and then you run into a huge situation where you have a big loss on your hands. Same thing with Pandora. If I show you guys the implied volatility chart, you can see how quickly implied volatility dropped, right? And this is, you go back to the video just last night talking about the trade as we set it up, and I showed implied volatility with these and just how high it is right now and the fact that it can drop so quickly. And you see that it's definitely what's happened. Every single time that a stock has earnings, you're going to get this type of drop in implied volatility, which makes it a really, really good one-day trading opportunity. Not that we want to be day traders, but we're absolutely going to take advantage of these things as they come. Okay, so that takes care of our closing trades. Again, great profits on those. Really excited about those. There's more earnings next week, so we'll have more opportunities to set up. I think next week is going to be the bigger week as far as calendars are concerned, with the number of stocks that are reporting earnings. I think on Monday there's 400 and something stocks that are reporting earnings. So it's definitely going to be a very, very active week, and we'll continue to do some of these earnings strangles to kind of accelerate our profits here a little bit in July. As far as opening trades are concerned, the first one I want to go over is CRM, which is Salesforce. We went ahead and sold a vertical put spread below the market. Now, if you remember from a couple of videos ago and what I was talking about as far as our overall portfolio, what I was trying to do with our overall portfolio is add a couple more bullish trades to our portfolio. So this is one of those things that we continue to add just to kind of balance out where we are. We had a lot of bearish trades in our portfolio. Not to say that we're not bearish, because I think the market's a little bit too frothy right now. It's a little bit too high. I could see definitely a little bit of a correction coming. But we don't want to be caught with our pants below our ankles if the market does continue to rally higher. So we want to have some of these bullish trades in our portfolio to take advantage of a move higher in stocks if that actually happens. CRM was a great trade today. We went ahead and sold the 50 strike put for September, and then bought the 55 strike put for September, took in a nice credit of 80 cents on this trade, and just did this on a very small margin of one lot. So it's just a one lot trade, but for CRM, really, really good trade. I think the setup is nice. I like the fact that the stock is starting to rally. Let me just get back to my base chart here. I like that the stock is starting to rally off of this base here. It's starting to move and trend in the right direction. It's kind of bouncing along this trend line below the market. And implied volatility when we actually entered this was about 51. So it's already started to come back down just a little bit. But we have a really good margin of error here. Our first strike is at 50. So it's almost $5 below where the market is, at which point we would start to lose money. So CRM can actually fall another $5 down to $50, and we would still make money on this trade at expiration, which I really, really like that kind of a setup. If we actually go into the trade tab here so you guys can see where our position is exactly on the calendar, we went out to September expiration, and you see that this is our strike right here at 50. So there's about a 70% chance that CRM does not get down to a 50 strike, and that's what it's trading at right now after the end of the day. So really, really good odds on this trade. It's about a 70% chance that this trade is going to be a winner, about a 30% chance that this trade is going to be a loser if we hold this thing all the way to expiration. So very, very high probability trade, which is what we want to add, and definitely we needed the bullish side of the market trading as well. The other trade that we made here today is FXE. We did a calendar in FXE, the 132 put. FXE has had a real tough time kind of gaining ground, but I think at some point it's going to start to at least stabilize here soon. So what we did is did a calendar from September to August on the 132 puts for FXE. Now, so with the calendar, just to recap, if we're buying a calendar, that means we are short the front month. So we sold the August 132 puts, and we bought the September 132 months, or 132 strikes. What this means is that we want the August 132 puts to start to decay in value because we're short those options. And as that happens, we want the September 132 puts to either increase or stay the same in value. So really all we're trying to get out of a calendar is basically the premium that's in the August 132 puts. And that's why it's really important. You want to make sure that you're at least selling some sort of valuable option there. You don't want to sell an August 132 that's worth $5 and try to get $5 out of it. It's just not worth your investment. But we did pay about a 48-cent debit for this one for FXE. So if we go over to the chart here of FXE, just so you guys can see the setup, like I said, it's had a real tough time gaining some ground here and kind of stabilizing. It's continued to move lower. But what we did is set up this calendar so that the biggest profit window for us is right around 132, and actually anywhere between about 131 and 131.5 and 132.5. So this is our big profit window. So we're leaving more room for FXE to actually fall a little bit lower, but hoping that at some point it starts to stabilize between now and August expiration. So I think that's actually a pretty good setup trade. Implied volatility is very, very low, so this is not a trade that you want to do an iron condor on. You don't want to be doing strangles or credit spreads on this. Implied volatility is very low for FXE. You want to be doing things like debit spreads and calendars. So this is a really good calendar for us. Definitely one that'll continue to act as a hedge against the market going higher. If stocks continue to go higher as they have, FXE might continue to go lower, just acting as a hedge against the stock market going higher. The other trade that we made here today is back to our old friend UAL. So UAL already had earnings, but implied volatility still remains pretty high in UAL, and rightfully so. The stock has been all over the place. And so what we did is went in here and did an iron condor this time in UAL. And you'll remember this is the one that we had a very aggressive strangle on. We had hedged it a bunch of times and decided instead of doing a strangle on this thing, because implied volatility isn't that high. It's not up in the 70th and 80th percentile. But implied volatility still is high, presents a great opportunity to make a trade. So we have to get back in here. Can't shy away from this stock as far as making some trades and trying to get something out of it. So with UAL, what we did is went out to September, so the next expiration month out, did the 49.50 calls, so sold the 49, bought the 50 calls, and then went back in and sold the 40.39 puts. So sold the 40, bought the 39 puts. All in all, after all the buying and selling of each of those, we took in a credit of 48 cents. Okay, so what I like about this trade is that you'll notice that the width of the strikes is $1 in both cases, right? And we took in a credit that's almost half the width of the strikes. So what's great about this trade is that we're actually risking $1 to make $1 basically, or risking 50 cents to make 50 cents on average. But we have this huge window of opportunity to make money between our 49 call and our 40 put. So if we go here to the chart of UAL, if my thinkorswim platform would cooperate. So we go here to the chart of UAL. You see implied volatility still very high up in the 56th percentile, and we're already past the earnings event, which is a good thing. So we don't have that on our horizon to worry us. But our 40 strike is all the way down here, and our 49 strike is all the way up here based on where it's trading. So I've actually given the market a little bit more room to the downside, assuming that after earnings, this kind of huge sell-off that happened after earnings will continue. So we might see a little bit of a drop here in UAL, but this is definitely a strategy that we're going to hold for a little while. We could see a really, really good decay in this, but as far as our window of opportunity, that's a huge window of opportunity. And basically anywhere inside this window, we make about 48 cents, and anywhere outside this window, we lose about 52 cents. Very, very high probability trade, even though our risk reward is about even on each side. So I really like this trade as far as our setup goes. I'll go in here to the trade tab so you can, not ALU, it's AUAL. So you guys can see exactly where we put these positions, and let me just expand these here a little bit. All right, so down here below the market, you see we have our puts on the bottom side here at 40 and 39. The first strike at 40 has about a 78% chance of staying out of the money, so high probability on that side. And on the top side, it's a little bit closer, but like I said, I wanted to give myself a little bit more room to the downside. The top side has about a 65% chance of being in the money or being out of the money at expiration. So fairly high probability on the top side, but I wanted to specifically kind of tilt my strategy just a little bit bearish based on what happens after earnings. If you wanted to go more neutral on this trade, you could do still the 40 strike on the put side and maybe go out to somewhere around the 55.5 or 55 strike on the top side. So if you want to give yourself a little bit more room, go ahead and do that with these iron condors. That's what they're made for, right? You want to be even on both sides, or maybe just a little bit tilted one way or the other. So if you want to be more even, or you want to give the stock more room to rally higher, then just move up your put side and move up your call side. So this is really kind of the beauty of an iron condor, is being able to make this type of trade where you can just really, create anything you want as far as strategy and profit loss diagram. So here's the payoff diagram for our iron condor in UAL. You can see it's very, very similar shape of a regular iron condor that you see. Very even on both sides. We don't have an unbalanced iron condor. There's no broken side here. And UAL is trading right now at 46.78. So again, we've left a little bit more room for the stock to rally or fall a little bit. That's ideally what we want it to do, is we want to fall somewhere in between 44 and 45 over the next couple days. And as that happens, implied volatility should go down and the stock should start to, or this position should start to decay in value, which will yield a profit for us. All right, so the last thing I want to go over is our quick little hedge trade on EMC. EMC is one of those ones that has really, really rallied after earnings. So EMC has popped and continues to rally higher. We originally had a debit put spread in EMC, the 27.26 debit put spread. And since we were short the 26 put and the stock has rallied, that put has actually decayed to the value of about 3 cents. So what we did is we bought back just the 26 put that we were short, paid a debit of 3 cents, and that allowed us to keep just the 27 put that's left as long. Now, I know a lot of people talk about doing this type of strategy with their debit spreads, but I think the key here with this type of strategy, if you ever want to buy back a stock that is short as far as the debit spread and keep the long leg, is just making sure that that long leg isn't worth a lot of money. Now, I don't expect us to actually make money on this trade. This is probably a losing trade, but at the end of the day, I want to leave this opportunity to have this 27 put open so that if in some case or some weird circumstance EMC does kind of fall in the next 21 days, that this gives us an opportunity to make some money back if it does fall really quickly. But the key here is that if we're leaving this 27 option open, and the whole intention here is that it probably won't make money, so we're going into this knowing that this probably won't make any money leaving this leg open, then I don't want this leg to be worth a lot of money. And in this case, it's only worth about $4. So I'm going to lose another $4 on this trade, but in my opinion, it's worth the $4 kind of lottery ticket just in case EMC does continue to move lower. I see a lot of people try to do the strategy on debit spreads, but they leave the long leg open when it's worth $40 or $50 or $60, and they don't account for the fact that they're also going to lose that $40 or $50 or $60. So the only way I would buy back this spread is if that short leg was trading for a really, really low price, and the long leg is trading for and is worth very, very little. So they don't have as much risk left in the market. You can see the 26 strike We paid 3 cents for it, which is half of a penny above where it's trading right now. And then the long strike at 27 is at 4 cents. So really, our whole idea here is that if EMC does, for some stupid reason, continue to fall back, and it's been known to make pretty dramatic moves. I mean, look at the move that it made back in the beginning of the year, and then also the move it made in March and April of this year. So it's not out of the question that this thing could turn all the way around, but it'd have to come all the way back down here at 27. So it was a pretty big move in the stock after earnings. Definitely unexpected as far as where pricing was for options and the expected move after earnings. But that's the name of the game, right? That's why you trade small. That's why you keep these positions small, so that this doesn't kill you if you invest everything you've got in this one trade. So as always, I hope you guys really enjoy these videos. I know today's video is a little bit longer because we talked about the group coaching and all of the opening or closing trades. But as always, if you guys have any questions at all, please add them right below here to this video. I'll get back to all of those tonight or tomorrow before the open, and happy trading.